the Fed. I don't want to waste any time, to be honest. We have 15 minutes to get prepared quickly. So what to expect, where are we headed? And then after the release, I think the first reactions will be already seen. I've prepared a nice layout in my chart, in my MetaTrader, so that we have 4 assets on our watch list, which we will go through, what to expect, when to expect what, in fact, dollar JPY, gold, NASDAQ 100, and also Euro USD. I think the first 3 will be of the highest interest. Euro USD probably longer term interesting. And yeah, straight away, let me share my screen and then straight away head through the slides. First of all, I'd like to mention something. I have the risk disclaimer at the end of the presentation. Very important. If there will be any trades or any setups I present to you, please be aware that this is just in demo mode, and that's just for educational purposes. So it's not that you should follow these advices blindly. Every trade you take is your own risk. You have to make get to your own conclusion out of what I present, or especially based on your personal opinion on the market, and then take it from there. So please be advised that this is not some kind of financial advisory or something like that. So just demo and just for educational purposes, everything we will see here. So the broker behind this event today is Admirals. Let's go through the stats of Admirals in a quicker way than we usually go within our hot topic webinars or trading spotlight webinars. Please visit the website admiralmarkets.com for further information on who this broker is. I think many of you watching this right now here live have probably already downloaded the demo. If not, highly recommend it. admiralmarkets.com for further information within this industry already. FX, CFD, brokerage, multi-asset brokerage. Now for over 20 years now. And one word, one broker. One important aspect I'd like to mention is fully regulated, and several regulatory bodies overseeing the business. The newest regulatory body or a regulator is now in Jordan. Also here, all informations can be found on the website. We won't go through shares today, or stock CFDs in this context. We want to make it broader and global macro, let's say. So we don't dig too deep into a Tesla or Apple or NVIDIA, whatever. But as of now, we have now fractional shares being offered. So that means that even if you say, I want to invest some funds and markets, probably because of today's Fed decision, longer term, you were thinking about when is the current drop coming to an end? And then I plan to invest some of my savings here. But I want to only invest, let's say, 200 euros per month. And a Tesla is currently trading around 850 USD per share. So that's not enough, 200 euros, not enough to buy one share. You can buy 0.4, 0.5, for example, so-called fractional shares. Also, all details can be found on the website. And well, let's go through today's agenda. And what we want to do is, first of all, to get an overview of where we stand right now, what to expect. We have to look at the so-called Fed Watch tool. It's an information which is available for free for every market participant. I will also share the link here in the next slide. Then we will look at the so-called dot plot. I think this is the key event today. So it's not about the rate hike or no rate hike, even though rate hike. If there's no rate hike, I think this would surprise markets massively. But there will be a rate hike, 25 basis points. But what will be of highest interest here is what the so-called dot plot delivers. And then we will look here at different trading scenarios. I have S&P 500 here, so we will look at the NASDAQ. I think it's of more interest because there is a higher sensitivity when it comes to yields, in fact, in the current market environment. And so first of all, let's have a look here at the so-called Fed Watch tool. Let me just copy the link and share it here in the chat box. So this is where you can get this information. And we have 2 slides here. So first of all, this is a screenshot I took several minutes ago, which is giving us an indication of where the CME, where futures are traded, is currently seeing, they derive based on options, and the so-called Greeks, they derive the probability of what the interest level will be in the future. And so based on that, they have this tool here where you can then check what is the likelihood, the probability, in fact, that the Fed will have or hike rates at a certain event here. So, and this is the two columns we can find when we check out today's column, so 16th of March, and we see here with a likelihood of over 96%, market participants expect the Fed to hike rates. So you can see this here, the x-axis 25 to 50, current rate level is here 0 to 25. So that means one hike is priced in nearly completely, 25 basis points. There was an increased likelihood that 50 basis points would be a topic that was especially at the beginning of February, after some comments from an FOMC member. His name is James Bullard. He is the official, the president of the St. Louis Fed, and he came out very, very hawkish. And based on his comments at the beginning of February, we saw a shot up here of 50 basis point rate hikes to nearly 100%. So market were really sure that the Fed will hike rates by 50 basis points. Then Ukraine happened, and then the Fed, and especially market participants, it wasn't really the Fed, but market participants scaled back on their bets here on a 50 basis point rate hike, and now this 25 basis point rate hike is nearly completely priced in. So this is no big deal, in fact. So if there's a hike, well, there's a hike, but everyone is expecting it. What's of higher interest is, in fact, what will the Fed deliver in the upcoming months, so till December? And this is the great thing about the Fed Watch tool. What you can do when checking out this tool here, you can click here, for example, on the 14th of December this year, and then you can see different columns here. And then from this, you can derive probabilities with which the market participants are expecting the Fed to hike to a certain level. So, and what you can see here is that by the end of the year, if you now sum up all columns here from the right, that the highest probability, in fact, or the end of this rate hike cycle is at 175 to 200. And this is played with a likelihood, in fact, of over 70%, nearly 75%. So 3 out of 4 market participants expect the rates to be between 175 to 200 basis points, so 1.7 to 2% at the end of the year, so in December. What does this mean? That means that we will see 1, 2, 3 rate hikes plus 4, 5, 6, 7 rate hikes in 2022. So today is the first one, and then 6 further hikes will follow till December. So, and this is what market participants will look at. And in this context, then we come to something we refer to as the so-called dot plot. Today is an event where the FOMC will deliver so-called economic projections. And I will also share this link here, even though it's from the last meeting. And this official statement here from the, let's call it dot plot. This is, I think it's 14 pages or something from the Federal Reserve they will deliver. And I think page 7 or so, if I'm not mistaken, 4, 5, 6, 7, somewhere there, you will find this chart here. And what does it show? It shows with each dot a voting FOMC member. And then they ask the FOMC member, so this is from December, again, December 21. And they ask, okay, what is your expectation in terms of hikes, or not just hikes, but rates at the end of the year for a given period? So 2022, 2023, 2024, and so on and so forth. And when looking closely here, you can see that in December, the majority of voting FOMC members expected the rates to be between 0.75 to 1%. So 3 hikes from 0 to this level. That was what they expected. And now what today will show is that these dots wander here on the upside. And as you have seen in the chart before here, you can see that market participants are expecting 7 hikes, bringing us to 175 to 200. So what market participants expect here is that these dots will be here. The majority of dots will be here in this column, slightly below 2%. So now the thing is that we can draw many conclusions out of this, because we can say, well, what is dovish, what is neutral, what is expected, neutral equals what is expected, and what is hawkish, so more what the market expects. I think the latter one, especially the hawkish one, is not what we should focus on here, but we should focus really on what market expects. So the dot plot comes in here, or the majority of voting FOMC members, and dovish will be everything where the majority of dots can be found here on the downside. And that being said, brings us now to the scenarios. I'm a little sorry that I rushed through this now. We will go through this once we have all details. I will share them via Twitter, by the way. So I will also give you the links then. But I go through this now a little quicker, and then afterwards we use the information, probably after we took also a trade, respectively, formulated the setup on what to expect. So this is a likelihood of 25%, but my favorite scenario, that they come in more dovish than expected. The reason for that is the Fed should be expected to somehow support equity markets, especially. So it's not just about fighting inflation, even though this could be a political issue right now. So I don't really know how much pressure from the White House and the Biden administration was built already on the Fed to probably come out more restrictive and probably not support the equity markets as the Fed used to support equity markets, because inflation pressure building, not just here in Europe, but also in the US, is adding to the pressure of the Biden administration. And this year we have midterm elections at the end of the year. That being said, probably increases the likelihood that the Fed is pressured from the Biden administration to do something against inflation pressures, meaning hiking rates. Only problem with that is that the current spike higher in inflation is not just is not resulting necessarily out of the massive monetary stimulus from the Fed, but it's because goods like especially oil, respectively, metals, and so on and so forth. Also fertilizers, in this case, wheat prices, everything is shooting through the roof due to the sanctions we have seen now against Russia after their invasion of Ukraine. So that being said, means if they come out more restrictive, that doesn't necessarily mean that they cut inflation pressure here, but it's probably just a short-term effect, if there's any effect on inflation at all. And the result could be that we are heading towards a so-called stagflation. So that being said, means I somehow think the likeliest outcome will be that the dots will indicate something 4 to 5 rate hikes in 2022 till December by 25 basis points each, which means, especially when looking at today the chart, the massive reversal we've seen in China, that equities probably see a short pull in, but then take off again. And we see here, in case of the NASDAQ, for example, a push higher. Gold, after its massive corrective move from all-time highs last week, now down to 1,900, probably sees a short flush below 1,900, but it's taking off from there. And dollar JPY, after heading massively higher, is probably headed lower than, correcting most of its recent gains. And Euro USD probably sees a push at least up to 111, probably even 112. So this is my game plan, my table. The second scenario is one where we can say this is what market expects. If we look at the dot plot, respectively, at the Fed Watch tool, I say the dot plot suggests something 6 to 7 more hikes till December, 175 to 200. We see some rhetoric trying to dampen too much hawkishness within the statement here, massively data dependent. Most likely scenario right now, one where I would say much of the hawkish news, let's say, is already priced in. And now let's head over here and just watch what the market will deliver. So you see gold here. This is the NASDAQ right here on the upper right. This is the dollar JPY. And here we have Euro USD. And I will head over to Twitter and do the following. So I will just retweet and try to guide you now through what we get to see, even though you can also probably draw first conclusions out of what will be delivered here within now the next seconds. So what do we get to see? So you see some slight bearishness also in gold. That means, okay, that was kind of kind of what could have been expected. Let me just see. No one is fast enough to tweet like that, obviously. So 1 second. Okay, that's already strong. I consider this to be strong. So I have no data right now. I'm not seeing what happened. I think as expected, most of it. Yes, they hiked 25 basis points. So that's the first one. I retweet everything. Okay, so we head over to my Twitter account in a few secs. Let me just see if we get some idea on. Okay, Bullard, the guy I just mentioned, voted for a 50 basis point hike. Could have been expected, so nothing big here, in fact. This is strong. This is really strong in terms of equities. So this is really strong. After the massive gains we've seen here over the Chinese markets, most Fed officials see as many as 7 rate increases in 2022. So this is very interesting. So that means the dot plot comes in as expected. So what market could have expected, which means here, this is giving an idea of why volatility is all in all subdued. So it's very hawkish when looking at it from a December perspective. But since markets have already priced in much of it over the last months, especially after January, we came in with the most bearish yearly opening on record. Okay, this is very interesting. Let me just see if probably there's a guy who's a little faster. 81, 25. Okay, nothing big. Okay, cool. So we have everything. We have everything already. So I don't need more now to draw conclusions out of this, to be honest. So let me just first of all here open my Twitter. I haven't opened it yet, but I will do that now, where you can see what I just retweeted. So now you have the flush here. So there's the flush. On the downside, gold is very stable. Could have been expected due to the fact that we've seen already a massive pull in here after this vertical move higher due to the Ukraine. And now let's get here. So this is my Twitter. So it's in German, but I retweeted everything here. In English. So very good account you should follow. Not mine, probably. Well, you can follow me too, but here Walter Bloomberg at Delta One, very great follow on Twitter with lots of okay, this is also interesting, with lots of tweets. So he got once banned because people were thinking he is a bot. He's not. So he's a human who's just copy pasting, in fact, Bloomberg headlines. And now I just retweeted another. So which is very interesting. Fed officials see inflation of 4.3% at the end of 2022 and 2.7 for 2023, which means after this massive run higher, that Fed officials are obviously seeing inflation topping out now, which is very interesting because then here there's this very hawkish stance with the most Fed officials saw as many as 7 rate increases in 2022. This is in fact a very hawkish stance because usually, or probably this is very hawkish if you expect inflation to top out now, but if you expect inflation to top out and are now bringing in this very hawkish stance, this is also giving you some room to scale back over the next months. So this is something which could then add some fuel here on the long side. But right now, so now we get to see the reaction here, especially in the Nasdaq. Let me just zoom in a little so you can see here. So let's go to a 5-minute chart. So you saw immediately some it was like nothing big happened, and now we see a flush here on the downside down to 13,700 points, 13,600 points. Let me just go back here to this slide. So this is the scenario we got to see. So the neutral scenario likelihood 65%. So my feeling was right in terms of likelihood, even though I favored this scenario here, the dovish scenario. So now you can see here what do we want to see, and why do I do this? In fact, so right now I'm fully prepared. So I know what I was expecting I know which levels to watch in the markets, which will be mostly interesting to watch. In fact, of the Qs, for example, here, respectively Nasdaq 100, the Qs are the technology sector ETF. And so I write, if holds 13,600 into the close, neutral to bearish if we drop below. So this is our key level to watch now on the downside. So what I want to see is that if I plan to go long, I want to see this current region, which we just spiked into, 13,600 points to hold. If we hold, then I could imagine the market to go for a stint up to 14,000 points in the next days. If we drop below 13,600 and we can hold this level, let me just zoom out a little. If we drop here below this region here, then probably we see a deeper pull-in as low as 13,400 points. But now, in fact, I want to wait and see. So I don't really want to take a trade against this level now, 13,600 here, even though we can see first flush and we hold this level, which is the first bullish sign. Still, we have to remind ourselves that we also get to see a so-called press conference. I'm not a so-called press conference, but a press conference with Jay Powell. And Jay Powell will probably deliver some remarks which could also add some fuel or volatility in this case to the markets, and which we will then have to see whether 13,600 can hold, or if we drop below that level. If we hold, if we get to see a reversal, probably if we see a sharp push higher from here, so not just holding that level, but Fed Powell comes out and then says, well, still data dependent, well, 7 hikes, but we see inflation topping out here. I mean, they can't really say whether inflation tops out or not, given the current developments in Ukraine, respectively Russia. So peace negotiations, or ceasefire negotiations, let's call them, made a big step forward today, if I'm not mistaken, and if I got the headlines right. But we don't know if the sanctions on Russia will be lifted and thus result in, let's call it a back to normal, with, for example, Europe taking oil or respectively gas from Russia, where these developments in terms of wheat and grains in general will lead to. So the Fed really don't know whether this will play out and if inflation tops out or not. And they've shown in the past that they were wrong many times, in fact. So that being said, depends a little, but let's just see. We can just wait or work with the levels which are of interest for us. 13,600 in case of the Nasdaq here. So first flush, we hold on point. Wow, that's not bad. 30,604. So let's see whether this level holds or not. If it holds, if we close above, then I could really imagine that tomorrow will be a next bullish stint here on the upside, which will probably bring us as high as 13,800, 850, today's highs, and then probably taking out this level, which will then level the path here. Let me just take out this trend line. This doesn't make sense. Which will then probably level the path up to 14,400 on the upside in the days to come. And which would then also mean, after seeing or having seen this short flush below the 24th February lows here in the Nasdaq, that we probably put in a bottom here and should see the start of a relief rally. What's also of interest in this context is something to remember. So we have a clear bearish picture. You can see here. So a trend line, which is clearly indicating that currently bears are in control. But the thing is, most of this hawkishness now is already priced in, was priced in. So the massive acceleration here on the downside resulted out of the developments in Ukraine, risk off mode and everything around this. You probably followed the news on this. And the initial push lower still was based on inflation pressures taking up and yields spiking higher. So most of this was potentially already priced in. So we have seen this game around the dot plot, which I just meant, or not the dot plot, the Fed Watch tool, already showing itself at the end of January, at the beginning of February, in fact. And so most of this is already priced in. The flush out moment, let's say, which was seen here, and which is probably now showing that we are about to make massive progress in terms of the negotiations between the Ukraine and Russia. This is now adding to, in my personal opinion, hopes that the bottom is probably in. And if we take out now this trend line here into the weekly close after the Fed, this is a clear bullish signal, which could lead to a follow through on the upside deeper above 14,000 points in the days to come. So I don't want to take the trade now. I want to wait. I want to see some confirmation. And now we can see why. So now we're flushing 13,600. Let's see if Powell delivers or not. If he doesn't, and if we fail again here to push above this trend line, then the risk is given that in the days to come here, we probably get to see another attempt to attack 13,000. So that's why I want to see whether 13.6 holds into the close or not. So that's it on the Nasdaq. So now let's come back to the presentation. So gold, also yield sensitive, certainly, has seen a vertical move higher given the developments in Ukraine. Risk off mode, we hit new all-time highs, in fact, not necessarily in USD terms. I think it was very close, but definitely in euro terms. And so now we have seen the market pulling in sharply after the first pressure was, or negotiations between Ukraine and Russia taking momentum, while in addition to that, 10-year US yields spiked above 2%. That being said, resulted in this sharp push lower here, in this sharp break lower. In fact, below a level here around 1,950, 960 points, a potential so-called cross support, I'd consider this. So we had an uptrend line. So a pull-in against this line was certainly something you want to see, but what you don't want to see is a break below that level. And this is what we got to see yesterday. So sharp push below that level. And so this is the first level on the upside. What's now very interesting is that the current development. So when I check here Twitter, we see, let me just see. Yeah, we see a spike higher in 10-year US yields to 2.21%. That's already 9 minutes ago. Probably that's what was already sold, respectively bought back in terms of USTs. But this push higher in yields is usually a bearish driver here for gold. So this is certainly something to be aware of if you see this massive pull-in and now gold not taking on further momentum on the downside. That being said, and holding, at least for now, this region around 1,900 is adding to my conviction that we are about to see probably a push up to 1,950, 960. So if we go down here from a daily chart to a 30-minute chart, in this case, what we can certainly see here is the level to watch now, which is here. I think this region around 1,926. Probably this is too far away, risk reward wise. Probably we should say if we break this initial high, pop high here of the release, and if we break above 1,917, I think we have a clear level to risk against the lows 903, 904, risking here 13 to 14 USD, and then going for a stint up to the breakout region 950, 960. So I'm playing for a bounce here, in fact, up to this region. If now Powell comes out more dovish, let's say, and is probably adding to some pressure on yields, respectively, pushing market participants into buying US T-notes in this case, which means due to the negative correlation here that we see buying in US T-notes then resulting in yields pushing lower, which would add to a bullish drive on the upside here in gold. I don't want to play the short side. If we make new lows now we would say, well, if we want to buy 916, why not sell 904 here and to break to new lows? Because I think we came in already massively. So the risk reward for a short play here is not that attractive anymore. So I wanna buy the pop high, let's say 917, 916, 917, risking against 904. and then going for a stint here up to 950. We'll probably, well, why not? I mean, this is, again, it's a demo, okay? So and it's just here for illustration purposes how to play that now. Let's go here for 0.1. I want to have a pending order. I'll work with a buy stop, and we are deleting the order once we breach 904. So stop is 904. Probably make 903. And to take profit will be around 955. So you can see the risk reward in this trade is 58, 38, better, nearly 3 to 1, 2.5, 3 to 1 in this case. So place the order, and then just see here. Well, it's a demo, so volume is probably a little heavy here, but still it's okay. So yeah, that's it on gold. So playing the bounce here. So Nasdaq, respectively equities, we don't want to take any position in that till we have confirmation that we close strong, 13,600. So then USD JPY, very interesting. I think technical wise, neutral to bearish because of the recent push higher. You probably have seen that. And I'm now going here. So I don't want to play this from the short side. That's something I can definitely say. But still, I could imagine that we'll probably get to see a retest here of 116, 116.50 breakout region. In fact, is an option. Probably we get to see a bullish consolidation. Why do I say that? Well, you have probably seen here. So this is a daily chart, and here you see this rising a triangle, so ascending triangle, and we saw the breakout, very massive breakout here on the upside. So this is the breakout region around 116, 116.5. Yeah, 116.5, and you saw the bullish breakout. And what's very interesting now is we can work with so-called projections on the upside. And so what we got to see so far over the last days, that JPY was sold, respectively, dollar JPY rose sharply. And there's one thing I'd like to keep in mind for the future. So what you will find out once you look at dollar JPY, and you probably have wondered, why dollar JPY? Why don't we focus on Euro USD here? Dollar JPY has a very high positive correlation when it comes to 10-year US Treasury yields. So T-notes, in this case, T-note yields. Which means if US yields rise, you see usually dollar JPY rising and vice versa. So if dollar JPY drops, it's most likely due to dollar yields, so 10-year yields in this case, coming in. And the reason for that is because the JPY is a so-called carry trade vehicle. So which means in an environment in which you see risk on tendency, respectively, market participants seeing the US economy taking on steam and inflation probabilities rising, you usually see yields rising too. And since we have a low to zero yield environment in Japan, which we got to see from the BOJ. In fact, since the 1990s, after the Heisei there and the big bubble, the Japanese economy crashed in the late 80s, respectively, early 90s, and has never reversed course. So we can, by the way, now we can here we can delete the order, by the way, because we dropped now 1,900. So the setup is now done. Dollar JPY, yeah. So now what we get to see usually is if yields rise, dollar JPY will also rise, and vice versa. So since we now spiked higher, but have much of this already priced into yields due to the hawkishness, which should be expected from the Fed, that means that I expect yields to come in rather sooner or later, which is also adding, by the way, to my overall bullish outlook for gold here. So probably this is just a flush out on the downside, and now we see a quick reversal with the press conference and the comments being made from Jay Powell. But now, if we add this knowledge in terms of yields and see this sharp push higher and this massive extension on the upside, I could really imagine here dollar JPY now coming in and probably see rather soon later a retest of this breakout region, even though the likelihood of such an event would be much higher for such a sharp pull-in if we got to see this dovish scenario. Right now, probably what we get to see is that the market was probably consolidating here at an elevated level and then continues to push higher up to 120. It's also something which is noteworthy when looking at dollar JPY. We have a very yield-sensitive currency pair. And since we don't really know whether yields, which are usually seeing a stability in terms of trends, continues really to pull in, we probably shouldn't be that sure that we get to see here this pull-in scenario. But probably instead of this pull-in scenario, we're about to see a horizontal consolidation. Yeah, so now the dust has already settled a little. So it's now 20 minutes after the release. We see gold dropping 1,900, not taking on significant steam on the downside, but still coming in more sharply. So now this is obvious. We broke this level here. Our fill, we never received one on the upside. And now what we want to see. So it's not necessarily over. I think trading wise, intraday trading wise, if you want to trade this news, I think gold is very interesting. Now we see the flush on the downside. We still have this bounce potential. I'm still thinking that we are probably done on the downside risk reward wise. I don't want to be short in dollar in gold here, but I think the bounce up to 950, 960 is more likely. But now I also know what I want to see. So, and what I want to see is I want to see here now the reversal taking place and gold holding above the breakout region 904, 905. So, and this probably about something like probably 10, 15 minutes, really holding above that level. And then if the market starts to reverse based on the comments being made from Powell in 10 minutes from now at the press release, then we probably have another chance here to enter long. In this case, for gold up to 950, 960 and risking against the lows here. So that means we have then again something like 10 USD risk, 11 probably here, unleveraged with the stop below the lows. But therefore, first of all, we need the confirmation that the selling pressure diminishes now. So I want to see gold holding above 903, 904 here, 905, above this green dotted line if you want, and then take it from there with risking against the lows and then going from 950, 960. So it's not a buy stop anymore, but now it's fully discretionary and me watching the price action and seeing if this level holds or not. So that's it on gold. Let's just here have another look at the Nasdaq, slightly below 13.6. So we're not yet done. So bulls are still fighting. Let's see if they can recapture 13,600. Let's see whether they can recapture that level. Let me just, by the way, just have a look here, a quick look at this chart. So what's big tech in general doing? So stocks, not just the index, but also stocks like Nvidia or Apple. So Apple is, well, given the lockdown in Shenzhen, is right now nearly flat for the day, slightly positive. Nvidia is holding most of its gains. So we've seen already a rollover. Yeah, already a rollover something like 2 hours ago. But it's still holding in the green. Tesla is also still positive. I mean, every stock, tech stock, right now is seeing some kind of pull over, but they're holding fine. I mean, this is not massively bearish. Probably this will end worse than what we're currently seeing after the comments from Powell. But also very interesting looking at Chinese stocks. I have Alibaba here on my other screen, holding around its daily highs, 28% for the day, massive reversal in Chinese stocks. So, well, I think we're not yet done on the upside. So probably this is like a quick flush out, but probably we will recover. It depends a little on what Powell will deliver. But if there are now some dovish remarks in his presentation, let me just see. If there are some dovish scenarios, which he will highlight, something like, I don't know, employment situation. If there's a top out in terms of inflation, I don't see it, but well, probably will happen. that they will then say, well, yes, we have right now taken steps, discussions into the direction. The dot plot is now, I'm seeing seven rate hikes. We probably have to hike rather sooner than later. 50 basis points. Probably now we take each event in May, then in June, and so on and so forth. You should expect us to hike by 25 basis points. The thing now is, if then inflation starts to really top out, this is probably adding to hopes among market participants that they say, well, now probably the next meeting, they won't hike rates anymore. Probably some kind of communication into this direction could add some bullish fuel. Let's see whether 13,600 holds into the close. And I just checked the questions now. Yes. So Darshan asked, wouldn't a logic not suggest a hike should cause a drop in the Dow and S&P? Yes, but you have to also see expectations among market participants. So that means if most of this expectation is already priced in, you get to see something we refer to as sell the rumors, buy the news, or vice versa. And this is definitely something to keep an eye on. That's why it's so important to run here through this whole Fed watch tool stuff and go here through the dot plot to see what is the market right now expecting, especially the Fed watch tool, because then you have the bias and you can hear, given this, if you draw the right conclusions out of this, you can see what the market is expecting and is prepared for. What does preparation means in this context? Well, buying insurance against a drop in equity prices. So if we are completely caught off guard, let's say, and now the Fed comes out and says like I don't know, we hike rates by one percentage point, let's say, because we have to fight inflation here. That would caught markets off guard massively, and massively result in a drop lower, since the market is not taking or hasn't not taken any insurance against such a step. But if most of this is already priced in and was priced in over the course, let's say a sector rotation, or let's say rotation from growth stocks into value, which has already taken massively place over the month of January, I'm sorry, then, well, this is nothing to worry about anymore. But based on pure logic, certainly yes, but economic behavioral aspects should all the time be taken into account. Okay, so yeah, well, we can also certainly have a look at the DAX. So you might probably be surprised and say, hey, why don't we watch the DAX right now? Why did we focus here on the Qs, respectively, on the Nasdaq? Well, because this is now where the music plays. So we can certainly have a watch here. Could watch also the DAX after today's sharp rise higher. Let me just see, where is it? Where's the DAX? Where's the DAX? Oh, here's right below that. Let me just drive it into here. So that's strong. That's strong. And I tell you why. Because we saw now a very massive bullish breakout. I'm sorry. So a massive bullish breakout here today in the DAX. So this region here was around 14,100 points. I didn't expect it to be taken out. You probably remember last week on Friday, we saw this news where Putin came out with a statement saying, well, there will be negotiations taking place, and first hope was seen among market participants that there will be probably a solution being found over last weekend. So we saw this massive spike higher into 14,100 and then sold off into the close. We saw another attempt to break higher into the start of the week, rolled over again quite heavily, and I was already quite sure that we do not get to see another attempt to break above that level, and it was completely proven wrong when I woke up in the morning, saw this massive reversal in China, and DAX bulls taking the ball here and pushing the DAX not just above 14,000 but above 14,100. And last week, that was a Monday, I think it was a Monday, I had a German webinar for admirals. Then I was just saying, well, if we can break above 14,100 and hold, even after the Fed comes out, as she now came out with saying, well, we will hike something like 6-7 times in 2021 till December. If we can hold this, that's a sign of strength, and I definitely consider this to be the driver for a more corrective move higher. Not really sure how far, and it's not necessarily meaning that this overall bearish environment is then or we are out of the woods, let's say, put it that way. Probably we get to see a test of this trend line here, which holds this bearish sequence of falling highs and falling lows in play. But we can at least get to see a test of this region. So if we hold 14,100, if we get support now from US equities, Qs, or respectively Nasdaq holding 13,600 and adding some bullishness here too, well, we're probably about to head up to 14,700, 14,800 into the weekly close. So I'd have this on my radar. And I also have a level on the downside where I don't want the DAX see drop below again, 14,100. So where put it, like, take a round number, I don't want to see the DAX dropping 14,000 again. Else, well, things start to turn out very dark, or yeah, so won't look very promising then if we drop 14,000 again. Yeah, but all in all, that's as of now, it's a sign of strength. So holding most of these gains here is strong. It's not that bad. And let's see if we see any kind of bullishness on the upside again. Holding again 13,600 in terms of the Nasdaq will potentially add to the bullish outlook for the DAX here, and then we probably headed for 14,700, 800 into the second half of the week. So in fact, that's it. So now, well, now the things start to get ugly a little. So now we drop significantly below 13,600. So dropping here, obviously, and giving back most of the gains. Let me just see. We have probably now comments from Powell coming in. Let me just see. So the press conference now started. Ooh. That's another one. Yeah, we didn't get to the fourth slide, but let's just here. This is the fourth slide, the hawkish scenario, and you can see that wasn't just like well, we have 7 more hikes by 25 basis points, but there's one here. Short word I use, QT. This is quantitative tightening, and it's the so-called balance sheet runoff. And Powell just said the FOMC expects to reduce size of balance sheet, which means they plan to reduce this balloon balance sheet. I haven't seen any details now, but this is something which resulted in massive volatility in Q4 2018 and will likely result in another higher volatility market environment here in the into the probably close of the year 2022, and this is adding to the bearish outlook for equities all in all. So if markets can recover from this short push lower here, and again 13,600 is our level to watch, that would be a sign of strength, but right now that doesn't look that promising. So looks more like that we probably will drop that level. Let's see if we hold 13,400. If not, well, then chances are high that we probably get to see another attempt to push to 13,000 in the upcoming days. Let's see what the DAX will make out of this. But probably such a move lower here in US equities will also spill over to the DAX then, and increase chances of a drop back below 14,000 points in this case. Yeah, as you can see here, we haven't made Euro USD a topic, and the reason for that is because it's not that yield sensitive right now. What's more interesting here is dollar JPY. Once we pull over here, if that happens, and rather sooner or later it will happen, since the risk reward on the upside is getting unattractive. This is the same which is true here for gold. So if you plan to play gold from the long side, it could be also interesting to play dollar JPY from the short side. So be really careful here if you take positions in both of them, gold long, dollar JPY short, since both are highly positively correlated to each other. And so yeah, that's it, in fact, from my end. I hope you enjoyed the event. So you have seen no trades being taken here, but we are getting interesting. This is interesting now. When we look at gold here, so have a look here. 904, 905. I'd like to see a holding above that green line. But once we hold above that level, gold could be interesting from the long side, up to 950, 960. That could be interesting. Also play for tomorrow, not necessarily today, but probably a play we should keep in mind and probably have a look at here for tomorrow for our trading. Let's see what the upcoming minutes will bring, what Powell will bring, if there will be any surprises. Right now, it doesn't seem as if there's. Okay, now some comments on inflation. Nothing big. Inflation remains well above goal. Okay, great. We know that. Supply disruptions larger, longer lasting than expected. Yes, no big surprise here. We expect inflation to return to 2%, and also inflation will take longer to return to goal than initially expected. Nothing to see here, to be honest. So yeah, so let's just see. So my level to watch right now, gold 905, the green line 906, holding above, and then let's see what equities make out of this. Let's see upcoming minutes, 1.5 hour till we close in US equities. 13,600 is the level to watch in case of the Nasdaq 100. And so yeah, I think all questions are answered. So I hope that you enjoyed the event. Let me just, by the way, see here. If I probably missed some questions on YouTube. Let me just see. Any questions? Okay, let me just use it. Okay. Okay, so okay, perfect. Yeah, hello. Hi Jens. Hello Jens. Yeah, I see what you're saying. Soroush says it's simply suicidal to trade the Fed interest rate news. I see what you're saying, but I don't necessarily agree. It depends a little on whether you're prepared well. If you know what to look for. If you see if you know the levels you have to watch. I mean, based here, for example, we did this based on the first reaction and based on then putting what we've got to see over the last week then into the overall expectation, which didn't come in as a surprise here. So the neutral scenario, much of this is already could have been expected, and then we take it from there. So you have a table of scenarios. Or first of all, you start out with, okay, this is what we expect from the Fed. Then we have a table of scenarios, what will happen if they really deliver what they delivered. And then we here look at the most interesting markets to watch: NASDAQ, gold, USD, JPY, and then we formulate trading ideas based on this. So a hypothesis. So the good thing about this is if it plays out, great. If it doesn't, you also know, okay, I saw this event coming with a high probability. It came, but the reaction I expected was completely reversed, up or down, depends on what you expected, and then you take it from there. So you say, well, I was bullish on this scenario, now we are bearish. This is a sign of weakness, so we probably should think about selling the news here. And then you can already see you're not emotional, but you take conclusions out of your research you put in, the work you put in before this event started. And then once you have a plan and you know what you're doing, it's not suicidal anymore, but it's more like a game of chance then. And you take it, the trades based on a hypothesis you can formulate and solidly trade it based on a favorable risk reward ratio. So I think from a regulatory perspective, I have to finish here with the contact details from Admirals. If you have any questions, please feel free to reach out to Admirals directly, send an email. But what I like to give to you now is the risk disclaimer. So please read it carefully. I hope you didn't take any trades. If you took any, please be aware that every risk you took there is the risk you were willing to take. And I hope you enjoyed the webinar. So that's it from my end. Hope to see you next week again on Friday, Trading Spotlight webinar. register at admiralmarkets.com, and also check out Marcus' morning show starting tomorrow at 8:30 German time in this case. So it's 7:30 UK, if I'm not mistaken. And he will certainly also go here through well, everything we get to see right now, put it in perspective, and then probably formulate some trading ideas based on that. So that's it from my end. All the best. Happy trading. Watch your stops. Have a nice evening. Enjoy yourself. Talk to you next week. I really look forward to it. Bye-bye.